Lipper is a global database with over 265 collective investments covering mutual funds, ETFs, domestic pension and insurance products.
Fund flows chat powered by Lipper at Refinitiv. Q1 Europe with
Detlef
and Tobias Hartmann. We are going to talk about the fund flows chat today. What is it about?
Well, Tobias, the fund flows in Europe are quite complex, and the fund flows chat shall give our listeners and readers of the fund flows report a bit more details on what we have witnessed over the first quarter in 2019.
So let's start with the first quarter. We review Q1 2019 European investors' return to the bond markets. Is it what you have observed in Q1?
Yes, this is some of the observations we made, is that investors returned to the bond markets. But before that, I think we should speak about the further developments in the assets under management in the European fund industry.
So the first chart you have prepared deals with assets under management. Did the European fund industry face higher assets under management in the first quarter?
Yes, of course. I mean, we had strong equity markets that contributed to the growth in assets under management. And we saw that the assets overall increased from 9.9 trillion at the end of 2018 to 10.4 trillion at the end of the first quarter 2019. If we break this down by product, as we see it here on the charts, we see that the assets in mutual funds are at around 9.6 trillion, while ETFs hold assets of 725 billion at the end of Q1 2019.
So thank you for the summary on that. Let's have a look into the asset types. Detlef, asset type-wise, bonds seem to be the only popular type. Is this correct?
Well, if you look on the flows, I would clearly say, yes, that's correct. Bond funds had, opposite to 2018, inflows in the first quarter 2019, actually 34.8 billion. And the other asset type with net inflows were real estate funds, which had a net inflow of 1.1 billion. All the other asset types saw outflows, actually 94.2 billion over the first quarter, which were driven by equity funds, which had outflows of 39.6 billion.
In a nutshell, that means investors seem to like real estate and bonds rather than equities at the moment, right?
Right.
Let's talk about details. In the next slide, you differentiate between funds and ETFs. That makes ETFs that popular. Is it about lower costs only?
Well, I don't think that it is about lower cost at this level. Some investors do take costs into consideration, but more in all, I would say that the product features of ETFs, which means you can trade them on the spot, in and out, in any quantity you want, are rather driving those flows. And of course, in a market environment where you have some uncertainties, you want to be as liquid as possible. And again, this is possible with the ETF, and you want to have transparency. So if you buy a mutual fund, active managed, you more or less buy a black box. If you buy an ETF and index funds, you know all the constituents and all the weightings of the constituents immediately because they are public information. But that said, if we're looking on the flows in more detail, we see that the trends towards bonds is driven by ETFs. Just the numbers, we had bond inflows of 34.8 billion, and 19 billion of that is coming from ETFs. This is really amazing because of the fact that we are in a low interest rate environment, and therefore you buy an index which is not having the most exposure to active management. So you can't avoid any losses once market starts to rise. And if we're looking on the equity side, it gets even more surprising, because in an environment with uncertainties, you mainly want to have an active manager that gives you the opportunity that in case of falling equity markets, they do their bets on the right places, and so you can earn money with it. But opposite to that, we had ETF inflows in the equity space. So once again, this is the point for my argument that people rather prefer to be having high liquid and high transparent instruments rather than instruments which have a long period to get out of it. I mean, you can sell a fund, but the transaction is made on the next day, and then you get your money back 2 days later. That's not what investors want in this kind of environment.
Let's have a closer look into detail. Detlef, what is selling worst? I have noticed that short euros, medium US dollar bonds, equity and absolute return funds seem to have outflows. Is there a flight into safe haven?
Well, first of all, I had to say it's a short euro. It's euro short-term bonds that have the outflows. And if you look on these outflows, you see there's outflows from money markets in US dollar. So the European investors expect rather the euro to rise, or they do different things with that money. And then we see heavy outflows from equity Europe, equity US, and equity Eurozone. Equity US was in favor over the last 2 years. People want to participate in the increasing equity markets in the US, while equity Europe and equity Eurozone have been a shaky time over the last year as well, because there were some quarters with inflows, some quarters with outflows. So it's not so surprising to see the outflows on the equity side. But that said, a flight to safe haven products, we can't see it. If you look on the other side, the best selling products, you see that bond emerging markets, global in hard currencies, equity global, bond global US dollar, and bond euro corporates were within the 5 best selling classifications, and therefore we can't speak about a flight into safe haven. And also you can see that investors pulled out the money from money market US dollars, which I mentioned before, and then you see inflows into bond global US dollar hedge. So they might have moved some of that money from money market over into bond global just to get higher returns from that. So if you look on that chart, you can see A, no flight into safe haven products, and B, the investors do favor credit over maturity. So they don't go into the maturity bands. They have the rather broad diversified funds that do all kind of maturity bonds in their portfolios.
Thank you for explaining this. So at last agenda point, you've prepared for us some detailed look into the industry. Let's have a look on the best selling promoter. On the top three is set with PIMCO, Credit Mutual, and Allianz Bernstein. Are these 3 usual suspects on the top 3?
Well, not really, but given the market environment, with a favor of bond funds, obviously PIMCO as the largest bond manager on the planet, that would have been expected. Normally you would see BlackRock there, especially when you see good times for ETFs, because iShares always contributed a lot of flows for the overall BlackRock brand. But what we witnessed this quarter is that the outflows from mutual funds from BlackRock couldn't be offset with the inflows from ETFs into BlackRock products, and therefore we are lagging BlackRock on the list of the top 20 promoters. Credit Mutual and Allianz Bernstein, or as it's normally is called, AB, they are always seem to be somewhere on that list, but not in the top spots. So that came as a bit of a surprise within that market environment.
Then thank you very much for giving us this little appetizer. So could you just summarize where I can find the full report? What is the full report offering for everyone who gets curious now?
Well, the full report is available for download for free on our website, lipperalpha.com.
Download the report. If you like the podcast, please provide feedback to us. Thank you very much. We continue with this series in due course. And many thanks to Detlef. The last word should be yours.
Yeah, thank you for listening to this podcast.